portfolio management. We start with the third chapter, and the third chapter, that is the bond and equity valuations. Okay. So in this chapter, we are going to understand the basic concept between what is the bond, what is the shares. Okay, what are the different, we can see the types of the bonds, or what are the different types of the shares, and we can say how the return on these two different investment avenues the investor gets. Okay, so that we are going to understand. That means the bond returns and the share returns that we are going to understand, and the evaluations of the these two different investment avenues. That is the bond valuations and the share valuations. So how these things we mathematically calculate that what is the formula for bond valuation, what is the formula for the shares valuation. So that's we are going to understand in this sessions. Okay, so already in the last sessions, I told you the concepts like what is uh, the bonds and what is the shares. Okay, in this sessions, I will also show you some, we can say, some graphical videos. So by we can say by this you can understand easily the concept, because you guys know that when we visualize something, we understand it better. Okay, whenever we see any cinema, any theater, in that 2 hours we easily understand the whole story, and we keep in mind that story for a longer period of time. So onwards that the short videos. I will show you for the different concepts so that you can visualize these things. Okay. Whenever I told you these things theoretically, okay, so you cannot visualize these things. Okay, how this happen. Okay, so by seeing these visuals, what I thought that you understand the things thoroughly. Okay, so first I will tell you the concepts and then I will show you some videos. Okay, so what is the valuations of the, we can say, the bonds and the shares? Okay, first we understand what is the bonds and what is the shares. I already told you in the last sessions. So bond is nothing but a document in which the all the parameters are mentioned of the loans which is taken by the company for some motive. Okay, the motive of the company, we can say, it whatever it may be, to fulfill the requirement of the working capital, to fulfill the requirement of the funds for their business expansions. Okay, so or to pay the, we can say, the other financial obligations. Okay, for these purposes, the companies and the organizations, they require the funds. Okay, so how they raise the funds? They have the two types of options. That is the bonds and the shares. That means they have the options that they can raise a loan, or they can issue a shares into the market, and through the shares they can raise the funds. Okay, so the basic difference in the bond and share capital, we can say. So in bond, the companies have to pay a interest on the loan what they are getting. Okay, so but in shares, there is no interest payment on the, we can say, shares. Okay, but in shares, we can say the ownership is compromised by the companies. That means the funds they get from the shareholders, with the same proportionate, they transfer the ownership to that shareholder. Okay, so that is the basic difference between the bonds and shares. Okay, so we can say on bonds, the companies have to pay, we can say, the constant EMIs, that is the monthly installments they have to pay. But it is not in case of the shares. Okay, on shares, whenever, because we know that shareholders are the real owners of the organizations. Okay, whenever the company earns the profit, okay, when the revenue of the organizations of the company is more than all the expenditures, okay, so the company enjoys the profit, then and then only the shareholders gets the dividend on the profit, because we know that the profit is the income of the shareholders, so that income distributed equally as per the shareholding to the shareholders of that organizations. Okay, so on bonds, the company is paying the interest rates, and on the share capital, they are paying the dividends. So we can say in bonds, there is no ownership transfer. That means if you take the loans from any single individual investors, from bank or from the different financial institutions. Okay, so there is no ownership transfer in case of bonds. Okay, because it's a loan. Okay, so but in a share capital, there is an actual transfer of ownership in the share capital. Okay, because we are not paying any interest. Okay, we can say welcomes that shareholders, that investors into the company as the owners of that organizations. Okay, so in shares, there is a actually the ownership transfer. Okay, so that's we can say a basic difference between the bonds and shares. Okay, so now we are going to understand what is the basic uh, how the value of bonds and how the value of the shares determine what are the factors which affects the value of the bonds and the value of the shares. Okay, so first, before calculating the we can say the value of the bond, first we understand what is the valuation, what is the basic definition of the valuation. So valuation is determines the fair value of the financial assets based on the expected future cash flows. That means valuation is nothing but the we can say the intrinsic value calculation, the fair value or the realistic value calculation of the financial assets. Okay, the financial assets, the bonds, and so bond is a financial assets for the we can say that investors to that bank who provides the loans to the company. Also, we can say that share investment, share capital shares are the assets for that shareholders. Okay, so okay, so in this sessions, we are going to understand how the value for these financial assets, that means for bonds and for the assets, how we calculate these values. Okay, uh, so before understanding the valuations of the company, there's some of the concepts is very much important for we can say as a finance students. Was we must know the what is the future value of the money, what is the uh, present value of the money. That is present value, so that we understand later. First, I will show you some. Uh, graphical learning videos, so you can easily understand the concept of bond and the concept of we can say shares. Okay, just a second, I will share this on my laptop.
However, to many investors, they remain a mystery. So, bonds are a common investment. However, to many investors, they remain a mystery. So, let's explore what a bond is and how it might benefit your investment portfolio. A bond is a loan given to a company or government by an investor. By issuing a bond, a company or government borrows money from investors, who in return are paid interest on the money they've loaned. Companies and governments issue bonds frequently to fund new projects or ongoing expenses. Some investors use bonds in hopes of preserving the money they have while also generating additional income. Bonds are often viewed as a less risky alternative to stocks and are sometimes used to diversify a portfolio. Consider this example. The hypothetical city of Fairview wants to build a new baseball stadium, so it decides to issue bonds to raise money. Each bond is a loan for $1,000, which Fairview promises to pay back in 10 years. To make this loan more attractive to investors, Fairview agrees to pay an annual interest rate of 2%, which in the bond world is also known as a coupon rate. An investor buys the bond at face value for $1,000. Now, let's fast forward. Each year, the city of Fairview pays the investor $20. These regular interest payments continue for the length of the bond, which is 10 years. Once the bond reaches maturity, the investor redeems his bond and Fairview returns his $1,000 principal investment. This bond was a good deal for both the city and our investor. Fairview got the money it needed to build the stadium. The investor received regular interest payments and the return of the original investment. Because a bond offers regularly scheduled payments and the return of invested principal, bonds are often viewed as a more predictable and stable form of investing. Compare regular payments of a bond to the experience of owning a stock. With stocks, profits and losses are driven by market forces and are generally less predictable. Of course, like any investment, bonds are not without risk. One risk that bond investors face is the possibility that the issuer defaults on paying back the principal. This is what is known as default risk. Typically, bonds with higher default risk also come with higher rates of return, also known as yield. The amount of risk depends mostly on the financial stability of the issuer. For example, many governments are generally considered stable issuers and issue bonds with a relatively low yield. Corporate bonds typically represent a greater risk of default. That's why corporate bonds often offer a higher coupon rate. Several credit rating agencies assign ratings to different bonds. This can help bond investors gauge the financial strength of the bond issuer. These rating agencies often use different criteria for measuring risk, so it's a good idea to compare ratings when considering a particular bond. And keep in mind, rating agencies aren't always accurate, so be sure to research a bond and its risks thoroughly before investing. Another risk to consider is interest rate risk. This is the risk that interest rates will go up, and any bonds you own will be worth less if sold before their maturity date. After all, when interest rates rise, more investors allocate their money into the new, higher interest rate bonds. If you wanted to unload a low interest rate bond to take advantage of these new rates, you'd have to sell your bond at a lower price than what you bought it at to make it a worthwhile purchase for another investor. Capital preservation and income generation are just two ways bonds might be part of a diversified portfolio. Many investors use a mix of stocks and bonds to pursue their investment goals, and because bonds move differently from stocks, they can help increase or protect portfolio returns. Keep in mind that this discussion showed you one simplified way that investors might use bonds and only a few of the risks to consider. Like all investments, bonds are complex and have a variety of uses and risks. Before you invest in bonds, it's important that you invest in your own financial education.
In this video, there is a brief, we can say, what is a bond and what are the different risks associated with the bond is very well explained. Okay, so here is one example is taken by the presenter that if you want to build any stadium, then what the owners of the land, he does, he takes the loans from the banks, and then he built a stadium. Okay, so whatever had the income he received from the stadium, he repay the loans he is taking from the bank. Okay, so we can say the bonds or the stocks are the we can say a less risky investments. B- Okay, as compared to the shares or the stocks, as we know, the value or the return on the shares and the stocks is determined by the market conditions. So there are some of the parameters, that is the economical condition, political condition. We can say we can show the social conditions. Okay, so all these conditions have a impact on the return on the with the stocks or the shares, but it is not case on the bond. If we as an investor invest in a bank, so the steady income, that is the constant income, some as common income is monthly we are getting from the bonds. Okay, so bond is, we can say, a less risky as compared to shares. We can say the return is less as the risk is less. We can say the only risk is associated with the bond is the credit risk. That means the, we can say, the default of payment by the company or to whom uh, we can say provides the loans. Okay, so if he defaults, he we can say the company is not in a position to repay the monthly EMIs, then this we called as the default risk. So this is nothing but the we can say a bond. Okay, so now we are going to understand what is the shares. Okay, so listen carefully, then you understand what is the shares as well in a brief.
Maybe you've heard about stocks, the stock exchange, or shares. What are they? And how do they work? What are they? Hey there. Maybe you've heard about stocks, the stock exchange, or shares. What are they? And how do they work? Stock represents ownership in a company. When you buy a stock, you own a tiny part of that company. So, imagine if you own 50% of YouTube stock, you own half of YouTube. Share is a single unit of ownership in a company. For instance, if all YouTube stocks consist of 10 shares and you own 5 of them, you possess 50% or half of YouTube. A stock exchange is where you can buy and sell stocks, such as the New York Stock Exchange, NYSE, or the NASDAQ. So why do companies issue stocks? Companies issue stocks to raise money for various purposes, like expanding their business or funding new projects. When you buy a share, you become a shareholder and get a share of what the company owns and earns. But how does stock really work? Let's break it down with an example. Meet Sarah. She's passionate about pizza and has a dream of starting her own pizza restaurant called Sarah's Pizzeria. After calculating, she realizes she needs $100,000 to start her restaurant, but she only has $50,000. Sarah has multiple options for funding her venture, like taking a loan from the bank or finding investors. She decides to find investors who want to support her business, so she sells ownership in her pizza restaurant. She divides the ownership into 10 small pieces called shares and sells them to interested investors. Since the total cost is $100,000 and she already has $50,000, which represents 5 shares or half of the total ownership, Sarah sells the remaining half ownership in 5 shares, making each share worth $10,000. Now, meet Alex. He's a pizza enthusiast who hears about Sarah's plan to start her own pizzeria. Excited about the idea, Alex decides to buy one share for $10,000 of Sarah's Pizzeria. By purchasing one share, Alex becomes a shareholder of Sarah's Pizzeria, owning 10% of the business and entitled to a share of its profits. With successful sales to 4 more investors, Sarah secures the $100,000 needed to start her pizza restaurant. 5 years later, Sarah's Pizzeria prospers, opening 3 more branches and increasing in value to $300,000. Alex, who owns 10% of the restaurant, sees his investment value increase from $10,000 to $30,000. If Alex decides to sell his 10% share, he would make a $20,000 profit. However, if Sarah's Pizzeria fails to compete or experiences lower sales, the restaurant's value could drop from $100,000 to $80,000. In this case, Alex's investment value would also decrease from $10,000 to $8,000, meaning he lost $2,000. Sarah's Pizzeria may eventually expand to become a national or international pizza chain like Domino's Pizza or Pizza Hut. As the restaurant's value rises, Sarah may choose to list it on a stock exchange like the New York Stock Exchange or NASDAQ, allowing the public to buy and sell its stocks. So, why people invest in stock? Because they hope the company will do well, making their shares worth more. They can sell these shares later at a higher price to make money. Sometimes companies also give out part of their profits to shareholders. This is called a dividend. But there's a catch. The stock market can go up and down, and sometimes companies don't do as well as expected. That means the value of the stocks can drop, and you could lose money. It's a bit like a roller coaster ride. So, if you're interested in buying stocks, it's important to learn as much as you can. Maybe start by buying shares in companies you know and like. Also, don't put all your money into one stock. Spread it out in some different stocks. You can buy the stocks for trading or investing, and I will explain both in next video. If you want me to make other videos,
The words stocks and bonds are commonly mentioned in the same breath, but they're very different investments. To understand their differences, let's start with simple definitions. A stock is a partial ownership of a company. It's considered an own investment, so when an investor purchases stock, they're actually buying a piece of the company. A bond is a loan investment, which means an investor is actually loaning money to an entity, like a company, government, or municipality. To put it another way, when an investor buys a bond, they're loaning money to a company in exchange for regular interest payments. When they buy a stock, they're buying a small piece of a company. Both assets can be bought and sold on the respective markets, and the prices can fluctuate, sometimes wildly. This can happen for a variety of reasons, like a particularly good earnings report or a new product release that turned out to be a flop. Because bonds are a loan, they can be a little more complex than stocks. Whenever a loan is made, certain terms have to be established. The same is true with bonds. When a company raises money through a bond, it's called a new issue. In a new issue, millions of dollars of bonds are commonly available. The issuer determines the value of the bond, also known as the par value. Because bonds can be traded throughout their lifetime, they may trade at a premium or a discount in relation to this par value. Like the name suggests, premium bonds are bonds trading at a higher value than their par value, and discount bonds are trading below their par value. Like most loans, borrowers must pay interest on what they're borrowing. With bonds, this interest rate is called a coupon. For example, a new bond may pay a coupon of $50 per year. Because coupons are typically paid twice per year, an investor would expect $25 every 6 months. So, a bond that has a coupon of $50 and a face value of $1,000 has a coupon rate of 5%. This is the interest on the loan. The loan agreement ends when the bond reaches maturity. Maturity is the length of time on the loan and is also the point at which your invested principal is returned to you. Bond maturities typically range anywhere from 1 to 30 years. Bonds with maturities less than a year are usually referred to as commercial paper or bills. Bonds with maturities of 1 to 10 years are sometimes referred to as notes. and bonds of 10 to 30 years are simply bonds. Despite having a maturity of up to 30 years, some bonds can be paid off early. These are known as callable bonds. When this happens, the bond issuer returns the invested principal early. The investor would keep any interest paid to that point, but the early repayment would end any future coupon payments. So let's review. When an investor purchases a bond, they're actually loaning money to an entity like a company. In return for the loan, the company will pay the investor interest, usually on a semi-annual basis. The interest provides regular and consistent income for the investor until maturity, which may be anywhere from 1 to 30 years, depending on the bond purchased. Both stocks and bonds have risks associated with them, like price declines, which can result in losses, and inflation, which can eat into your returns. Bonds also face some unique risks, like credit risk. This is the risk that an issuer defaults on coupon payments or fails to repay the principal at maturity. This could cause the price of the bond to plummet and significantly reduce your returns, potentially all the way to zero. Bond ratings can help investors determine the likelihood of this happening, but ratings can change. Another risk of investing in bonds is interest rate risk. If interest rates rise, the value of your bonds will decrease. This typically only matters to traders who want to sell bonds, though. If you plan to hold your bonds until maturity, this won't impact the principal you receive when your bond matures. At maturity, the investor receives their initial investment or principal back. Keep in mind, not all bonds are the same. Some come as secured or unsecured, providing varying degrees of protection. Some carry different interest rate structures and offer various repayment schedules. Investors should keep these factors in mind before investing.
Uh, so from all this, uh, what I thought you understand now clearly what is the stock as well and what is the basic difference between stocks and bond. In the presentations of the stocks, there is one example is given that various and you can say one lady Sarah who wants to start the uh, pizza restaurants. Okay, but she don't have the enough we can say money with her, and for that purpose she is required we can say the one uh, we can say the 1 lakh US dollar. But he only has the 50,000, so also she needs the 50,000 US dollars. So what she do? She we can say raise the funds through his one of the friends, that is Alex. The same likewise some more four investors he find it out and takes the funds. We can say the 10,000 US dollar from each of the investors, and after the we can say after the 3 years his restaurants grow 3 times. So automatically the 10,000 investment of the Alex, so how whenever in the share we can say in the share capital, whenever the wealth of the organization or the company grows with the same proportion, the value of the shares holder is also gets increases. That means when the valuation of the restaurants goes from the 1 lakh US dollar to the 3 lakhs US dollar, then automatically the investors value which goes from we can say the from the 10,000 to 30,000. That means after the 3 years, if the Alex wants to sell his shares, okay, so he can sell it on a value of the 30,000. That means the 20,000 is the return on the 10,000 investment. So this is how we can say the shares capital works, and the basic difference as we see uh, as I told you in this sessions also, what is the basic difference? So that on bond we pay the interest, on shares we pay the dividends. So in bonds we do not transfer any ownership. In share capital, that the companies transfer the actual ownership. Okay, so this is we can say the basic difference between the bond and the shares. Okay, now we understand how the value of the bonds and shares determined. Okay, so before understand this, first we need to understand what is the future value and the present value of the money. Because we know that the transactions in the bonds and shares, the sum of the financial transactions happen today, that is in the present times, and the sum of the financial transactions happen in the future times. Okay, so whenever as the investors, yeah, if I we can say if I give the loans to any company, any individuals, then this we called as the we can say the initial transactions. Okay, but how that company repay the loans to me? The on the basis of the monthly EMIs. Okay, so each year the companies pay me the 12 monthly installments. Okay, if we can say the maturity of the bond is the 10 years, so continuously in the future 10 years the company is going to pay the monthly installments. Okay, so all these we can say all these 120 monthly installments are the future cash flows. We consider this as the future cash flows because the cash flows we considered in the future times. So all these are the future cash flows. Now we understand in the concept of the time value of money. We know that the value of the money goes down as the time goes. Okay, because of the sum of the factors who affects the value of money. That is the first factor is we can say inflations. So because of the inflations, we can say the purchasing power of the money gets decreases over a period of time. uh, if we take the example that the overall prices in the economy is increases by 10%. That means average price rise in the economy is a 10 rupees. Okay, or we can say the 10%. Uh, if the price of the any particular good is the 100 rupees, then the that product's price will goes up by the 10 rupees. So that is the concept behind the inflation. That means today we are getting the petrol on the price of the 110 rupees. Okay, if the inflations in the economy is 10%, so in next year we will get the petrol on the we can say the 110 rupees, 10% is 11. So 110 plus 11 is the future value of the we can say the next year's price of a petrol. That is, in next year we will receive the petrol on the price of 121. So now we can say the purchasing power. That means for the 1 liter of petrol, today we need to pay 110 only. But for the same quantity of petrol, in next year, I will have to pay the more amount of money. That is the 121 rupees. That means the purchasing power. Okay, the purchasing power of the money gets decreases because of the inflation effect in the economy. Okay, so how this inflation we can say how this time value of money, that means the value of money today is greater as compared to the value of money in the future. That means today's 110 rupees is equal to the 121 rupees in a future. That means uh, today's 110 is equal to next year's 121 because they purchase the same amount of same quantity of petrol. Okay, so we can consider here the 110 is equal to 121 because they are doing the same work. Okay, today 110 purchase the 1 liter, next year the 121 rupees purchase the same amount of petrol. That means the purchasing power of money gets decreases. So this is the effect of the time value of money. Okay, so whenever we can say as we can say have the some future transactions. If you know that in future I will receive this much amount, but we calculate the present value of these future transactions by using the formula. So there are some mathematical formula to calculate the present value of the future cash flows. Okay, so there are the with the help of the reverse formula, we can calculate the future value of the today's cash flow. So this is the concept of the future value of the money and the present value of the money. Okay, so here the one example is given to you, that is the value of today's 1000. uh, if here is one example is given, that is we know that after the 3 years the 1000 US dollar received at the 5% discount rate. That means we are going to receive the $1000 after 3 years at the what is the discount rate, that is 5%. That means the value of the money degrades at the 5%. What is the discount rate is the 5%. So we can say uh, we will receive the $1000, but what is the value of we can say the present value of that $1000? So if we calculate that, then we need to apply a one formula. So that formula is the present value is equal to future cash flow divided by 1 plus discount rate raised to power the number of years. Here is given is the number of period. That means the number of years. If we calculate the present value, that is present value is equal to $1000 divided by 1 plus 5% raised to power 3, then we will get the value, that is the $863. That is the $863. That means with that with today's $863, what the goods and services we purchase, we can purchase the same goods and services with the help of $1000 after 3 years. That means that today's 863 is equal to $1000 of after 3 years. So this is the concept of the time value of money. That is, we can say the uh, future value and the present value. Okay, so that concept we apply in that concept we apply while calculating the financial transactions in the bonds and the stocks, because we know that in futures we are going to receive the different we can say financial transactions. So that because of this we apply this concept, that is the time value of money in a while calculating the value of stocks and bond. Just a second, I will show a very nice video to you guys on this, what is the time value of money. Okay, so from this you thoroughly you can understand what is the time value of money. Okay, just a second.
Value of money explained clearly and quickly. After all, time is money, right? What's important about money in the context of time value of money explained clearly and quickly. After all, time is money, right? What's important about money in the context of spending money, saving money, or investing money? First of all, how much are we talking about? Second, money when? We need to know both the amount as well as the timing of the money. To explain that second item, timing of the money, let's search for equivalent amounts of money in time. Would you prefer $100 today or $100 1 year from now? I'm pretty certain you would say $100 today. Why wait? What about the choice between $100 today or $101 next year? I would guess that you would still prefer the $100 today. 1 year from now, the prices of goods or services that you want to spend the money on could have gone up. That's called inflation. Inflation could tear up that extra dollar, or even more than just $1. You might be worse off. Plus, let's admit it, you probably don't have the impulse control of having to wait a whole year for just one additional dollar. Better take the $100 right now. How about $100 today or $110 next year? I'm pretty certain you would take the $110 1 year from now, as that sounds far more attractive. Okay, somewhere in between then. How about the choice of $100 today or $105 1 year from now? Maybe you will say, I'm fine either way. If that's the case, then we have just found the equivalent amounts in time and identified the time value of money for you. The time value that we found for you in this example is that $100 today equals $105 in 1 year. $100 is the present value of $105 1 year from now. $105 is the future value 1 year from now of $100 today. Now I'm going mathematical on you. $105 equals $100 times 1 plus 5% to the power 1. The future value equals the present value times 1 plus the rate of return to the power of the number of years. The present value equals the future value divided by 1 plus the rate of return to the power of the number of years. That might be a big abstract mathematical leap. Let's review it with an example. The future value equals the present value times 1 plus the rate of return to the power of the number of years. Let's expand our example to 2 years. $100 today multiplied by 1.05 is $105 1 year from now. That same $105 1 year from now multiplied once more by 1.05 is $110.25 in 2 years. Or if you want to go straight from today to the future value to 2 years from now, $100 today times 1.05 times 1.05 equals $110.25 2 years from now. 1.05 times 1.05 is the same as 1.05 squared, which is the same as 1.1025. We can also work in the opposite direction. The present value equals the future value divided by 1 plus the rate of return to the power of the number of years. $110.25 2 years from now divided by 1.05 is $105 1 year from now. That same $105 1 year from now divided once again by 1.05 equates to $100 present value today. Or if you want to go straight from 2 years from now to today, $110.25 divided by 1.05 times 1.05 equals $100 today. 1.05 times 1.05 is the same as 1.05 squared, which is the same as 1.1025. Time value of money is the idea that money that is available at the present time is worth more than the same amount in the future. With the rate of return, you can convert from present value to future value and the other way around. Time value of money is also the underlying principle for concepts such as net present value and internal rate of return. I hope you enjoyed this clear and quick explanation of the time internal rate of return. I hope you enjoyed this clear and quick explanation such as net present value and the other way around.
So Here, if we clearly, if you guys understand the today's 100 rupees, we can say $100 or 100 rupees is equal to the 105 rupees in the next year. So why this is? Because we can say the discount rate or the rate at which the value of money degrades, okay, because of the inflation rate. Okay, some of the times maybe the inflation rate is equal to the discount rate, because with that same we can say rate, the value of money degrades. So here is given with the help of the formula. So what is the formula for the present value? Present value is equal to what is the, we can say value, first we understand what is the formula for future value. Okay, so future value is equal to present value into 1 plus r raised to power n. Okay, so that means the future value it is always greater than the present value mathematically. Okay, we mathematically we say these values are differ, because of the discount rate or the inflation rate. We see the future value is the greater one. That means when we calculate the future value for the 100 rupees at the discount rate of 5, okay, then when we calculate that 100 into 1 plus 5% raised to power n, okay, we get the 100 and 5 rupees. That means mathematically we see the 105 rupees is more as compared to the 100 rupees. But actually, in we can say in financial terms, okay, we say that the next year's 105 rupees is equal to today's 10 rupees. So this is the concept behind the time value of money. Same likewise, whenever we calculate the present value, if I calculated the 105's next year's 105 rupees is today's value, that is the present value, then we what we do, we can say that 1 plus r is to power n. Okay, we transfer from one side to the another side. Okay, so we know that whenever we send in any equation the any thing from the one side of is equal to sign to the another side. Okay, so if that things is in a multiplication, there goes on to the another side in the division. Okay, if the sign is minus, then it goes on the another side with the sign of plus. So this is the basic mathematical rules. So when we calculate the present value, so we get the formula, that is the future value divided by 1 plus r raised to power n. Okay, so whenever in the same we can say the bond valuations or the equity valuations, whenever we have the some future cash flows, we calculate their present value with the help of this same formula. That is future value is equal to present value is equal to future value divided by 1 plus r. So r is the discount rate and n is the number of years. Okay, if I for example, if I take the example that after the 10 years that I'll get the 8 lakh rupees. Okay, and we can say the discount rate is 4%. So how we calculate the is the, we can say the present value of 8 lakh after that which we are going to receive after the 8 years. So we calculate the present value of 8 lakhs with the help of formula, that is the present value is equal to 8 lakhs divided by 1 plus 4 raised to power n. Okay, so some value we receive with the help of this equations, it might comes near about the 4 lakhs and 50 or 4 lakhs and 50,000 rupees, so near about this. So that means that we will see mathematically the value of the future amount is more, but in financial terms, in terms of the purchasing power of this money, we say that these two values are same. So what you guys seen in this video, okay, so what you are seeing on the screen, that $100 today is equal to the $105 in a 1 year, after the 1 year. So this value mathematically we say the $105 is more, but in not in case of the we can say in a financial concept. Okay, we say these two values are equal because the purchasing power of these both the amount of the purchasing power of different goods and services is the same. So they these two value can purchase the same amount of goods, they can purchase the same amount of petrol, they can purchase the same amount of vegetables, they can purchase the same amount of whatever we the goods and service we want. Okay, so this is the time value of money. So while calculating the bonds and shares value, that we apply this time value of money concept. Okay, so in next sessions we actually see the formulas, the how the value of bonds and how the value of shares are calculated with the help of this concept, that is time value of money. Okay, so till now if you have any questions, you can ask. We have 5 minutes left. Okay, so you can ask the questions if you have any questions on bonds, shares, or on the time value of money. Okay, you can ask. Are you guys? I'm just checking that you guys listen the sessions very carefully or not. If I call some of the people's name, if you present, please unmute yourself and said yes, sir. Okay, so please tell your name. That yes, sir, I'm Nayan is here, or whatever your name, Vaishnavi, Ankush. Okay, so I start with is the Pramod is there? Pramod Anamusi, Deepak Jadhav, Darshan Vidate, Kunal Sakure,
Yes, present, sir. Kunal Sakore.
yes, yes, Ashwini Pawar,
Present, sir.
Adarsh Patil. If you present, please unmute yourself and tell me yes, sir. Adarsh,
Yes, sir.
Tejaswini Nirmal. Is Tejaswini there? Tejaswini Nirmal, Ankita,
Yes, sir.
Mansi Kopde, Ashwini Katkar, Shruti Kamble, Ritesh Jadhav. Is Ritesh there? Ritesh Jadhav, Vaishnavi Gangani.
Yes, sir.
Yes, good. Devesh Dumke, Aniket Dhumal.
Yes, sir.
Okay, good, good, Aniket. Suhani, Ankush Dandale, Prajakta Chauhan, Vaishnavi Swami, Nayan Supekar, Pranav Badguzar, Devesh Dhumke. So,
Yes, sir.
guys, please.
Pranav
Yes,
Balgunda.
yes, 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 Pranav, good. So, guys, please try to, uh, I think, listen this lecture series carefully. So, this is all the efforts we are taking from home, from for all of you. Okay, so please give some attention so that all the faculties can feel that whatever efforts we are taken for you, so you listens and you understands very well the concepts which we are telling to you guys. Okay, so it's already this 6:59, so you can leave now and you can join the another sessions. Thank you, guys.